All right, guys, welcome back to the exciting Future FX trading course. What are we up to? Lesson 3. Still trying to get through all the basics, but tonight's going to be all about candles and candle patterns. Now, I'm pretty sure I mentioned it in previous lessons, but candles are these lines on the screen, it's the green and red ones. So I'm going to go through exactly what a candle is first. So let me find a good one to explain a few things on. All right, let's talk about this one green candle just here. This one here. You can see how most of the candles are made up of a big solid body, which is what it's called, the main body of the candle. And then we've got the little thin pieces at the top and the bottom. They're called the wicks. Now, what that all means, one other thing quickly is we've got the green ones are ones that have started down here and they've gone up. So the market's increased in price. And the red ones have started at the top here and they've gone down. So they're where the market's going down in value. But get some drawing tools going here. When this green candle opened, so this red one finished. So each one of these candles at the moment is a 15-minute period. So from the time the candle starts until it finishes and starts a new one is 15 minutes. That can be changed, but at the moment we're on 15 minutes. So when this little red candle finished, right there, that's where this green candle started. And the green candle finished right there. But at some stage during that 15 minutes, that green candle made it all the way down to there and all the way up to here, well, to the tip of that green wick. Okay, so it started here. It could have gone up and down several times, but at some stage it made it all the way to there and all the way to there before finishing right here. Now, a few of those things will become important later, but I just wanted you to understand exactly what everything about the candle actually means. And then you can see some other candles, like this is actually a candle, but there's no real main body. It just means it started and finished it in the same place, but it did make it down to here and all the way up to here at some stage. I'm going to go through and explain. I've just did a little bit of homework myself before the call, and I circled a few specific candles that I wanted to talk about. So they were easier to find. But one thing that I didn't know when I first started trading was, why the market goes up and why the market goes down. And it's extremely simple. You might have heard that it's supply and demand, which it is. But all it means is if you've got a green candle or even, just a green candle, that means during this 15 minutes, there was more, maybe not more people, but there was more of that currency being bought than there was being sold. And on the red candles, it just means there's more being sold than there is being bought. So there's because a lot of people, let's say a lot of people want to buy euro at the moment, that makes it a buyer's market. So you're like, if we want to think about it like real estate, if it's a buyer's market, if there's lots of people trying to buy a house, but only a few people trying to sell it, then those people selling are going to be able to get a much better price because there's a lot of people willing to buy a house. It's the same here because there's a lot of people wanting to buy. It means that it's going to push the price up. And likewise with real estate, if you've got a whole heap of people trying to sell their house, but only a couple of buyers, then that's, they're going to have to sell their houses cheaper. So the price is going to come down in order for them to be able to sell it. So it's exactly the same here. And if we're looking on a bigger scale as well, this is the seller's market. All the houses are being sold. But, people are, for one reason or another, which we will get into more of, but more people are wanting to sell at the moment. And, then over here, everyone wanted to buy. And when it reached a certain price, that was too high for everybody. So they all wanted to sell. All right, so now I want everybody to speak up if anything's confusing or they want something to add. We'll learn a lot more if we make it more like a discussion type of thing anyway. So I'm going to go through a few different types of candles. And you can see I've circled some. I might just go through them one at a time. No, one at a time's no good, actually. Because I've circled some that are good examples and some that are bad examples. So there are a few types of candles that may indicate, like individual candles on their own can tell you a little bit. A combination of candles can tell you something at times. Maybe not enough to base an actual trade off, but it can be another thing that you can use to add to your trading plan in order to place a trade. What I'm meaning by that is you wouldn't just place a trade because the market was on support. You wouldn't just place a trade because there was one candle that said you should. You want a combination of both of those and something else in order to place a trade. So I'm going to get into what those candles are now. So what we're going to look at here now is what's called an engulfing candle. All right, so we've got a candle, and then the next candle, this green one, it's obviously you got a red one, then you got a green one, but the green one is much bigger than that red one, meaning that the markets come down here, and because we've got this wick, the markets come down, but then it started to come back, and then the next candle has engulfed all of this candle and gone a bit further. So for it to be an engulfing candle, it has to engulf all of the body of this candle and the top wick and a little bit more. And it has to be the body of this green one, which is fully engulfing from where this candle finished right up to the highest it ever went. So that green body has to engulf all of that. And so that's what we would call a bullish engulfing candle. And that's an indication that the market has sort of reached the bottom and is going to start moving up. And, you can see that hasn't gone up very quickly, but you can see that's generally what's happened in this case. And you have exactly the opposite as well, where I don't know if I've circled one of these, but if you had a green candle and then the red one engulfed all that down further, that would be a bearish engulfing candle, indicating that the market may move down. So there will be homework on these terminologies. It's always hard to find something exactly like what you want. But we're going to look at a 3-candle combination now, which is either called a morning star or an evening star pattern. So this one here, we've got and these are better if you find them right at the top of the market. So these are going to be indicators that the market's going to change direction. So this market's already coming down though, so you already knew it was coming down, but it's just a good one to indicate. So we've got a big green candle, a little red one, and then a big red one. And this would be an afternoon candle pattern. And for it to be valid, this has to be a very small one. And this I'll get into what this candle's called as well, and I'll do it now. It's what they call a doji, meaning that it's got a very small body and wicks on either end. And all that means is the market's gone all the way up, all the way down, and all the way back. So it's just very indecisive. It's not telling you anything at all, really, except that the market's not clearly going any one way or the other. So you need a big green candle. You need a doji candle, or it doesn't have to be a doji, but just a smaller. It can be green or red. And then the next one needs to be red, and it needs to go all the way down further than the bottom of the green one. And that's an indication that the market's going to be moving down. Over here, we have the opposite, which is just a morning star pattern. And it's just the opposite. We've got a big red one. We've got a little candle, and then we've got a big green one, which goes further than the red one does. And it's important that it does go further than the red one. Otherwise, it's not going to be definite at all. So, for example, up here, we've got a green one, we've got that little doji, and we've got a red one. So that's almost an afternoon star group, but the red one doesn't go below the green one here. And you can see, even though it did end up dropping a bit, it came straight back up. So that wouldn't be an evening star group at all, simply because that red one stops here. It needed to go below that green one. So just here, I'll circle this here for these two candles. What would I be circling them for? I need a bit of input from you guys. It's one that I've just mentioned before, so you should be able to get it. Or people just don't like talking.
It's an engulfing candle. Sorry, I was on mute.
That's all right. Yeah, exactly. And that would mean that the market's going to move down, wouldn't it?
It's going up, isn't it? If it's a green one.
Yeah, I know. I was trying to be smart.
Oh, sorry. You're trying to catch me out.
I know you understand all this,
but
I'm just trying to make people that might be watching this as a recording start to think about things a bit as well. But yeah, so this is a really good example of a bullish engulfing candle, because it fully engulfs more than ever. And then you can see that it's also done what it indicates, and the market's gone up considerably. We're going to have a whole lesson on exactly where to enter the market. But if you're using an engulfing candle as your last little thing to enter the market with, you would enter most of the time when that candle finished. So when this new candle started, that's where you would place your buy order and take profit. And in this case, it would have been a good one. What you don't want to do is, while the candle's still active and it's right up here, it looks like an engulfing candle. So you think, oh yeah, I want to get in as quick as I can. You don't want to place your buy order there, because that may come up and then right back down here by the end of the candle, which would mean it is no longer an engulfing candle, because it's only a wick that's up there, not the body. And, if you get a big long wick on top, that would be indicating the market may go down. So you always want to wait until the close of the candle. There are a lot of different strategies, as I've mentioned before. So I'm just trying to talk basics at the moment, not any specific strategies, but we're definitely going to get onto some specific ones in the next couple of lessons. So here we have a perfect example of a evening star pattern. We've got a green one, we've got the little one, and we've got the big red one. And the big red one's like an engulfing candle. It's engulfing the green one. but it's just got a little one between it as well. So it just meant that the market's gone up, and it stopped going up for a whole candle. So it moved up a little bit, a reasonable amount in 15 minutes, and then for 15 minutes it sat there doing nothing, and then it came down a long way. So that's a perfect example of an evening star pattern. And as you can see, the market has continued to go down significantly more. Oh, cool. Here's one that I haven't talked about yet.
So Les, on that one, can I just ask a question for the
Sure.
sake of the call?
Yeah, good.
So that's quite a large red candle, but you'd be entering at the point where the next red candle starts. That's where you'd place your sell order.
Correct, because you don't know if this is going to be a big red one until it closes. It could retrace right back to here on you.
Mhm.
And if I'll get back to that in a sec. I just want to talk about this candle here, okay? So this is what they call an inverted hammer, simply because it looks like a hammer. It's got a big long handle and a little heavy head on it. Okay, so hammer, inverted hammer. So what's happened here is the candle's opened here and it's gone all the way up to here, but then it's come right back down to here. So that means that the market went all the way up, but then for whatever reason, which we're not getting into at the moment, it's then bounced back down rather sharply. So because it's gone up and then come back down, that's an indication that the market may be moving down. Okay, so over here, if this big red one that we were talking about before, if it didn't close here, if it came all the way down and you entered the market earlier, it may come all the way back up to here before it closes. And then that would be like the opposite of this one. It would be a hammer, which would be indicating, because it went down and sharply back up, it would be indicating that the market's going up. So, even if that happened in the last 1 minute of the candle, that would take it from an evening star pattern that's indicating the market's going down to a hammer, which is indicating the market's going up. Now, what Diane was probably also inferring when she mentioned that was that we might come across a better example, but sometimes you'll get this pattern and you'll get this, maybe this red candle went all the way down to here. Sometimes when that happens, this is just too big, and also, the market stopped going down here before. So if this red candle didn't, or finished right down here and it became a really, really big red candle, even though it's still an evening star pattern, you may decide that it's too late to enter the market because you think it might not go below here anyway. So, it's good to have a really big one, but if it's too big, there's the potential that you may have missed half of the trade opportunity, but you also can't jump in early because you don't really know what's going on yet. But in this particular case, you can see that if you had entered the market here, it would have just went against you a little bit, and then you would have had a good profit. So even if you don't really have questions yourselves, guys, and you think that a basic question may sort of help out someone that's watching this later, please speak up. I think that might be all I circled there. I know there's another one. That was also a morning star constellation, morning star pattern. And the one in the middle here is also a hammer. So, we've got a big red one. We've got a little one, but it's also got a big wick on the bottom, which means it's come down and sharply back up. So that's a hammer, which would mean the market's going up. And then we've also got the green one saying the market's going up. I mean, it didn't go up sharply or anything, but it didn't really get much lower, and it did start going up a bit. And sometimes, depending on the time of the day, the candles can mean more than at other times of the day. Like this big red one here was obviously due to a red folder news event, which we'll get into at some stage as well, I guess. Did I circle any more? Let me have a look. Don't think so. All right, so they're the main candles that I wanted to talk about tonight. And just to quickly recap, we've got the engulfing candles. So if the last candle was a green one, that's engulfing the red one, means the market's going up. And obviously, if it's a green one that's getting engulfed downwards by a red one, then that's a bearish engulfing and the market should move down. And we've got the evening star patterns, which means the market has been going up, and that indicates that the market may then start going down, which it did, but not for long. Same over here. We've got the evening star pattern, and it did go down further. This was the morning star pattern, and the market did go up after that. Sometimes it may not go up much, but depending how you're trading, I will get into this as well. It's hard to try and fit everything you're thinking of at once into a short video. So in this case, you would have placed a trade at the top of the green one. You wouldn't have, but I mean, if we were just using this as our last little indicator to place a trade, you'd be placing a trade here. You'd put your stop loss here, and you could have taken profit here. So you're sort of risking the same amount as you're winning, or maybe not. So that may not be a good trade. Over here, we've got these good little tools that are for working out risk to reward, which we haven't gone through yet, but we will shortly. So we've got the bullish engulfing candle. So if we were trading, we would have placed a trade right where that candle closed, and we'd want to put the stop loss, below the most recent structure. So we'd want the stop loss, somewhere there, and don't take this to heart because we're just doing some very basic stuff here. We're going to get a lot more into how and when to enter the market, and where to place our stop losses and take profits and all of that. We just got to get through the basics first. And the market did go right up to there. And so it gives us a risk to reward ratio. What that means is if this trade had gone against us down to here, this is where we would have placed our stop loss. And for argument's sake, let's say, because it's sort of a general one, you don't want to risk too much of your account on each trade, but you want to try and risk the same amount every trade. So let's talk 1%. If you're risking 1% per trade and the market had come down to here, you would have lost 1%. But if it had gone all the way up to the top, like it has, that would mean you'd make 2.4% or 2.44 times whatever the loss was. So for every 1% you're risking, you're potentially making 2.4%. So that, and this is trading in hindsight, so it's a lot easier, but that would have been a very good trade because you're risking a lot less than you actually would have made.
Les, can you just explain what tool you're using there on TradingView?
This one?
Yeah.
So I've got them all up here on my little hotbar, but I will have a lesson on just TradingView, but this one here where it just says long position, that's where you find those ones. Long position and short position. Cool. So the one I used here was obviously a long position. And so I got the long position and the short position just there ready to go.
So have you had to put that in? Yeah.
So what you do is if you want to add something to your hotbar up here, you just open up whichever tool you want and you highlight it with a star. So if I wanted to add this one, I would put that one in there. And now I've got it up here as well, see?
So is that what you're using, the forecast option, when you just did what you did?
No, I use the long position
Long position, okay. Yeah. And then it draws all of that and speculates what it would or wouldn't have done.
Yeah, so I'll get rid of that. So I've got the long position one.
Yeah.
So I'll click on that, and I'll just click exactly where I intend to place the trade.
Yeah.
Bang,
Got
it
you.
does that. And then you just
Perfect.
drag the bottom to where you'd put your stop loss, drag the top to where you want to put your take profit, and you want it to be a nice positive risk to reward, preferably.
So you can do that with TradingView retrospectively to do a bit of like back testing or checking what a trade might or might not have given you in return. Thank you.
And we've got the hammer, or the inverted hammer. So little body right at the bottom and a big long wick at the top means the market's gone up and it's coming down. So that indicates it's coming down. And the opposite way around would just mean the market's going up. So that covers the actual candles and candle, small individual candles and small candle patterns that I wanted to go through. I just saw, I'm going to move on to market patterns now. So not just 1, 2, or 3 candles, but a lot more as well. So, and these will be things that indicate that the market's going to go one way or the other as well. So right here, we've got, let me just draw a line first. So I'm going to draw a line at the bottom here, and you can see that the market's touched there, and then over here, it's come down to exactly the same. It's the same distance. All right, so that's what we would call a double bottom. So the market's been coming down. Not in this case, not much, but it's just been coming down. And so like in that last lesson, we started talking about market structure, and we had a high, a lower high, and we had a low and a lower low and a lower low. But with our high and our lower high, the next time we formed a higher high. So the market structure is changed. And then the next time we formed a low, it wasn't a lower low, it was just an even, the same height low. So that's what we term a double bottom. And that's indicating that market structure has changed, which when we formed a higher high here, it was an indication that it may have been. And then when we failed to form a lower low, that was sort of giving us more confirmation that the market structure of a downward trend had stopped and possibly changed. And obviously, and obviously that's what's happened. We've got the double bottom, which means the market's likely to go upwards, and you can see it did go up significantly. So that's a double bottom, and you can obviously get that at the top as well if the market's been going. If the market's been going up, and then it does that, you get a double top, that would be an indication that the market's going down. And in this particular instance, where you would be looking at entering the market just solely based off this, which, as I've mentioned, you don't base it just solely off one thing, is you would be entering the market when it broke above the highest high here. So this higher high. So the market, we've got the double bottom, so we're going, okay, the market could be going to start going up now, but you don't really get full confirmation of that until here. But if we get our little tool here again and we come down to, let's just get rid of that one and start a new one. As we just said, we would have entered the market once we broke above this higher high here. So we would have entered the market, about here somewhere. We would have had to put our stop loss below here, so just below this line. And at this stage, you don't know where the market's going to go to, but in hindsight, we still could have had a 2-to-1 risk to reward. So that would have been good. And I'm saving a whole lesson for where to place stop losses and take profits. But like in this case, we've just determined that the market's hit the bottom here by getting a double bottom. So we're placing the stop loss a little bit lower than that. The reason, and this is the same reason for any stop loss, you don't put a stop loss somewhere just because you want it to be there. You know, or maybe I wanted a much better risk to reward. So if I put my stop loss there, I've got a 9-to-1 risk to reward. Okay, so that sounds a lot better, but you can't just put the stop loss anywhere you want. It needs to go where it needs to go. And that is below, in this case, is below that blue line. And the reason it goes there, we've already mentioned one reason why. Hang on, that's my bread maker. I've got a brace of bread ready. So that's the reason why it goes below there, because that's where we found the bottom. But the other more important reason is that we're basing this buy order off the fact that that's the bottom and that the market's broken above here. All right. So that's our analysis that's telling us the market's going up. If the market was to only come to here and then come down lower than this blue line, that would invalidate our entire analysis. You know, so this is good analysis. You know, that it's bottomed twice. So we found, you know, in this case, you would call that support. We've bounced twice, forming support, and have broken above this last high point. So, you know, that's a good entry, so to speak, but they don't all play out. And if the market was to come right down to here, we formed a new lower low, which would indicate that the downward trend is still going. So our analysis that the market's going up would be invalidated once that market went below the blue line. So that's why that stop loss is there. And if you see the market turn around and come down to here, and it looks like it's going below the blue line, too bad. You just don't touch it. You let it either touch where you put your stop loss or turn around and come good. Because until it actually breaks below that blue line, it hasn't invalidated your analysis. Until it goes and forms a lower low, the potential for an uptrend is still there. And so this is where human emotion, which will be another whole lesson, comes into play. Is, you know, we'd see this and it might have gone into profit and then it might have dropped right down to here. We'll go, oh, this isn't working. I'll close it out and minimize my loss. As soon as you do that, the market bounces off this blue line again just before your stop loss and then goes right up and you kick yourself. Okay, that happens a lot. And the reason that would happen is because we've just identified that we've found support here. So even if the market comes back down, there's a very good chance that it could bounce as soon as it hits the same place that it bounced last time and the time before. So you have to stick strong on where you put your stop loss, because before we place the trade, we've done this analysis. You know, we've decided that, you know, everything's indicating the market's going up. We've put our stop loss here, not because we wanted to, but because that's where the market indicated that it was the right place for it to be. So you have to leave it there. As soon as you've placed your trade based off the fact that that's where the stop loss is going to be. If you change it after you've placed the trade, then you're basically throwing away all the analysis you did.
Roughly how many pips underneath that blue line of support would you give it, Les, in your opinion, experience?
I guess it depends on what time frame you're trading and everything. You know, if you're trading like an hour time frame, a little wick below that would could sometimes happen. But that a little wick on a 1 hour could be, you know, 10 pips. Where on the 1 minute, a little wick probably at 1 pip. So that'll play a factor. But really, as long as it's below it, technically, it is. I do tend to give it a little bit of leeway as well. But in this particular case, as long as you've got that blue line on the very bottom of the lowest wick in these two circles, then, as soon as it goes below, then you've really invalidated your analysis. So it really you should let it take a loss.
Thanks.
But the thing is, and what most people that aren't traders or even new traders don't understand is that, like this particular trade setup we have here, we're risking 1% to make 2. So we've got a 2-to-1 risk to reward ratio, which means you can lose 2 trades for every 1 trade you win, and you would break even. So if you were, that would mean if you only won 33% of your trades, you would break even. So if all your trades are 2-to-1 risk to reward, you really only need to win 34% of your trades to be profitable, which only 1% profitable, but you get my point. I just sort of wanted to mention that because that's something that people really don't understand when they first start out. A bit like, the market's going down. So especially when it comes to crypto and things, people sort of know you're involved in crypto. So, and let's say the value of Bitcoin starts to go down a lot. They go, oh, you must be hating this. The market's dropping out. It's losing value. You must be worried. And, the answer is, as a trader, you don't care because you're making money as the market goes down as well by doing the sell orders or shorts. The fact that you can make money as the market loses value is something that non-traders don't understand either. All right, I've got another chart here with a few more things to go through.
Hey, Les.
Yes.
With the candlestick patterns, how do you incorporate that into making trade decisions?
All right, let's go back to this one. All right, so as I said, we've got a good example of a bullish engulfing candle here, but like just a couple of candles isn't a good enough indication. You want a few different things, but let's say this support line here was here. Okay, so not only have we got the bullish engulfing, but it's done so by bouncing off support. So now you've got 2 things coinciding, saying that the market's going up. Okay, so that's, I think you should always have at least 3 things, but that would be 2. And another thing you could use is if the overall trend of the market on either the 15-minute or another time frame up, let's say the 1-hour time frame, was if the trend was going up as well, that would be, the trend would be up. We've bounced off support, indicating it's going up. We've got a bullish engulfing indicating it's going up. So now we have 3 things indicating the market's going up. So in that case, you could probably take a trade. Does that make sense?
Yeah, that's great. Thanks.
So, like we've got indicators, thousands of them, that do all various different things. And they are what they sound like. They're things that indicate which direction the market's likely to go, or they're giving you some other information that you can use that will indicate which way the market's likely to go. An engulfing candle, it's an indicator. It's indicating which way the market may go. Support line, that's indicating that the market may bounce at that position, and it may go up. And I really am struggling to not mention all the smart money concepts, the fair value gaps, the order blocks, supply and demand, and all of those things, which will really take your trading to a whole new level. And like we were saying in the chat there the other day, Kevin, on my prop account when I passed it, which I just passed it in 3 days, but that last night I was placing some trades just with an order flow. Well, there's another term we haven't gone through, but after the market had bounced off a 4-hour order block. so I just placed those trades on the 1 minute time frame. I closed one out at just 2-to-1 risk to reward. Or I put a take profit at just 2-to-1, just because I like to get. I had 2 trades going, and just because I like to get some profit under your belt. Close some out as you go, just so you don't miss out at all. And the other one, I ended up closing it out at 5-to-1 risk to reward. And the only reason I closed it out at 5-to-1 was because that had given me my 8% and I'd passed the challenge. So that was 2 trades that I had running simultaneously, because I just sort of stacked 2 trades. It was the same trade setup, but I had 1 trade and it got into profit, and I was able to stack a second trade on it. And that was enough for me. They were only 0.5% risk trades though, but I still was able to make 3.5%, just really quickly on the 1 minute, and basically had no drawdown doing it. So that the idea, I really didn't want to get into this, and I'm not going to, but the idea, just say, the idea behind all those smart money concepts that you may or may not have heard of, like order blocks and fair value gaps, is that if you understand them and practice, and but more so than any of this other analysis that we've ever done, it can give you a much more accurate entry into the market, meaning you can have a much tighter stop loss, a much longer take profit, giving you a much greater risk to reward ratio. So 1 to 10 risk to reward ratios are more than doable, even more than that. So anyway, we're not getting into that tonight, but soon.
Les, can I just ask then,
Yep.
for people that aren't so used to trading, I mean, we were just looking at things that had happened in the market, and you're using those tools on TradingView. But if
Yep.
you were going back on Kevin's question, you're looking to see when to get in the market. If you see an indication of those 3 things happening, do you sort of guesstimate when you're drawing those tools on TradingView, where
No.
to put so not guesstimate, but from the top part, because you didn't know how high up that was to go.
Yeah, exactly.
You know where your stop loss got to go, but then you just work out the 2-to-1 or the 3-to-1 or whatever you're looking for your take profit. Is that how you do it?
No, take profit should also go somewhere for a specific reason. There can be a lot of different ones, and we will get into this a lot more as well. But so I explained why the stop loss has to go there.
Yeah.
If this hasn't occurred yet, as you said,
Yeah.
we didn't know. So this, as you said, this was in hindsight. But
Yeah.
what we need to do is look left. Always look to the left to see what the market's done previously. And so we will do that, and we'll see what we can find. It will depend, sometimes there may be nothing. All right, so I've got the blue line, we ended the market there. Just follow this blue line back a bit more. We may have only looked this far and would have seen that the market's bounced off there. So in that case, maybe we would have decided we had to put the stop loss there, which wouldn't have given us a very good risk to reward. But a good thing to do is to actually, if there's no market structure above, close at hand, it's good to have a look at a higher time frame. And now if we have a look on the higher time frame here, here's our little trade. And there's a huge, big fair value gap that you don't know anything about yet. But here's this market came right up to here before. And the market's been right up there. So in this case, what I probably would have done is I would have taken my little thing here and I would have dragged it all the way up to there somewhere. And now we've got almost a 4-to-1 risk to reward ratio. So I probably would have done that based off the fact that the market was above up here. When I'm taking really big risk to rewards, this may not necessarily be a great trading practice. Well, it is, but I wouldn't just wait until the market got right up here. I would close out a partial trade further up, like wherever this line was. Maybe I'd close a bit out here to make sure I locked in some profit and let the rest run. And in this case, you would have seen we actually would have taken profit right up here.
Yeah, the thing is keeping in it,
Just
isn't
take
it?
a bit
Rather than when you see it come back down. That's the trick. Yeah. Yeah.
Yeah. So that's why like the take profit also needs to go somewhere for a reason. With what we've learnt in our lessons here so far, we've got, you know, wicks or bodies, wherever you want to put it, but roughly there somewhere. Or what we were talking about the other night was, you know, drawing zones. That would be a resistance zone or the top of the range zone. I prefer to call it the top of the range zone because that's where it went up to. Once you understand smart money concepts, support and resistance will become completely obsolete for you. So I'm trying to get away from calling that resistance, but it's still important as far as the fact that it's the top of the range from where the market's been to. You know, so based off the fact that we know that, I would place my take profit, you know, somewhere just before that, just before it, simply to make sure it gets hit. You don't want to push your luck too much and put it there and have the market turn around here and go down and take your stop loss out. So always err on the side of caution just a little bit. All right. Oh, hang on. I just saw something that I forgot to mention. Back here. It's not a circle, but I did draw on the chart there to remind me. I'll get rid of it so you can see. I couldn't find a really, really good example of this, but this is what they would call a head and shoulders pattern. And all it means is the markets come up and down. That forms your left shoulder. And then it's come up and down. That's your head. And then it's come up and down. And that's formed the right shoulder. What that's indicating is that the market's reversing direction. So in this case, the market's coming up and you get the head and shoulders pattern, meaning the market's coming down. Now, head and shoulders, that's what they call it. All it really means is that the market structure's changed. Like we're talking in the last lesson, we've got a high, we've got a higher high, we've got a higher high, but now we've got a lower high and a lower high. And likewise, we've got a low, we've got a higher low, an even low, and then a lower low. So all it means is the market's changed direction, market structure has changed, and it just forms that pattern. And you can also get reverse head and shoulders where, you know, the market comes down and comes back, and then it comes down, forming the head and the other shoulder, and it does that. Now, where you would place a trade based off this is the bottom of the shoulder, so what they call the neck, which is basically where that blue line is, because they've got the shoulder and then where the market bounced to form the head, and there it came down and bounced to form the other shoulder. When the market breaks below that, that's your indication to get into the market and do a sell order. Same with this one here. You know, oops, wrong one. You know, the neckline is here where the two shoulders sort of bounce. So you do a buy order when it breaks the neck. Sometimes, of course, it's never neat like that. You can have a shoulder and you can have a head, and the other shoulder might be there. So your actual neckline's going to be on an angle, so it's never quite as defined, but you can maybe enter the market. I wouldn't enter the market here though. I would still wait until the market got above this highest neckline, and then you would trade up. A lot of these things like head and shoulders and other patterns, it's simply indicating that the market structure has changed. Although we do have a few different things I'm just about to go through here. And I'll probably try and hurry up because I reckon my roast is about ready. Patterns like this would probably look even better if I try to get back on the 15-minute. So ignore all of that. The market's come up and then it's come down. It's come up a bit further and it's come down, it's come up and it's come down. So like in that last lesson, it's formed I've just drawn a trend line here, connecting these, the lower high and the lower high. And down the bottom, I've basically just done the same, but I've connected the low points. So you can see and so once it's come down here, here, and here, you could connect these two together and extend that trend line. You could connect these two low points and extend the trend line. And then you can watch the market. It's going to keep bouncing between these. The market does this a lot. And these are very good indicators and things to keep an eye on, because as the market's getting squished into this little tiny apex, it's got to do something. And as it's getting squished tighter and tighter, when it breaks out, it tends to break out significantly. As you can see, it did. Once it broke out, it banged right up, so it broke out significantly. What you want to do though, depending on the pattern, it can give you an indication of which way it's most likely to go, but you're best off waiting for the breakout and even waiting for, like here we've had a breakout in a little bit, so that doesn't matter, but then we've had a decent breakout and then the market's pulled back a bit. That's when you can get into the market and trade up. So this is just depending on the shape of it. This one here, if the bottom line's completely straight, which it could have been, that would just be called a descending triangle, which most of the time would tend to break downwards, but not always. So you should watch for it. It'll depend on what it's been doing before as well. So a descending triangle can mean that it's going to break down, but as you see, not always. So you wait for the break and then trade. Wait for the confirmation of which way it's going to break first. If you drew the two trend lines and you got a more perfect little triangle, they call that a equilateral triangle, obviously, which it'll still just bounce between and break one way or the other. This one won't indicate which way it's going at all. It could go either way. And obviously, if you've got one that looks more like that, then it's an ascending triangle. And most of the time they will break up more often than not, but they still may not. So you still always want to wait for the break. I circled these just as a double bottom type thing, except it was like a triple bottom. So you can see the market's been coming down and it bounced in the same place, bounced in the same place again. So obviously, for whatever reason, you don't even really need to know why at this stage. For some reason, the markets tried to go down, couldn't, tried to go down, couldn't, tried to go down, couldn't. So for some reason, there is support there. And then the market's eventually given up trying to go down and it's gone up. So double bottom, sometimes triple bottoms. I like that other one. This could have been that other double bottom scenario we had where we had the trade and where I explained where the stop loss went. If this had been that, we might have placed our trade here and our stop loss here. But if we'd have seen this coming down and closed our trade and taken a loss, then it would have almost hit our stop loss, but not quite, and then gone all the way up. So that's why you have to wait. That's why you have to leave your stop loss where it belongs. Because in this case, it looks like it's going to go bad, but it's bounced off the support and gone up, which is, we've identified support. We've identified where the market is having trouble going below, and we put our stop loss below that. So that's important. What else have I drawn? All right, so just here, these are called flags, and they call them a flag. You got to look at it like this. We've got a flag pole, and that's just mean the market's steeply come down, and then it's consolidated. In this case, it's just sort of worked its way up a little bit, but it's still consolidated. And generally with a flag that drops down and then consolidates like that, it's most likely it's going to break downwards again, which it has here. And it doesn't really matter. Sometimes that flag may just form a nice little square like that, just going completely sideways. Other times that flag, maybe the opposite of what this one was and then coming down. Either way, generally if we've got a strong drop and then that consolidation, we'll get another drop as well. There's a lot of theories about how far it'll drop. You'll hear people say if the length of this flag pole will be how far it'll drop again. That can be true, I suppose, but it's also going to matter. It's going to depend on, what's happened to the left. If you look further enough left, you might find support here, in which case, that's as far as you can expect the market to go. But that's flags, flag poles, whatever you want to call them. So we've got the other example here. We've got a flag pole. Actually, we've got a flag pole, a big long consolidation, which is a bit too long in my book, and then it's broken up, almost the same distance. Look, and then we've got the flag on the flag pole, and then it's broken up again. And you can find these examples over and over again. So it's no surprise. Trading's just about finding patterns, really, knowing what the market does when certain things happen. So this one here is just another flag, or if it's the other ones were flags. These ones here, because they form a triangle at the top of a flagpole, they call them pennants. So same thing though, really. It comes up and it's getting squished into the apex. But because it's come up, we've got a pole going up, squished into the apex. Mostly it's going to break to the top on these ones. They're just really good ones. They still wait for the breakout, but this one here though isn't a flag because there's no flagpole or anything. But if we connect the high points and we connect the low points, we're getting a triangle. No, sorry, I don't want to call it a triangle. We get a wedge shape. So, but because the wedge shape is going up, the market most likely breaks down. So ascending wedges going up, ascending wedges mostly break down. And, if it was a descending wedge, they mostly break up, but you still wait for the break to be certain. I don't know if I do anything else or not. Doesn't look like it. Not to worry. There are a whole heap of other patterns like these ones we've just been going through as well. There's books and books. You don't even need a book. Just Google chart patterns and you'll get heaps of them. But there's another one here where the market's coming up a fair bit, and then it really just consolidates or ranges in a tight area. So the market starts to range in a certain area there. So if that happens, it doesn't even matter what it's called, but you just let it range and until it breaks. It may break up and you do a buy order, or if it breaks below, you do a sell order. We'll go into. Sorry,
sorry. I was going to say there's that good like guide book called the Candlestick Bible.
Yeah, I've actually got some. I've got some ebooks too. I'll have to track them down and I'll share them in our trading group as well.
Yeah, I've got the Candlestick Bible on a PDF if you want.
I think I might have that one, but we'll see what we've got. Whatever, they're easy enough to share in a Telegram chat.
Yeah.
But yeah, that's pretty much all I wanted to go through today, guys. One of the I forgot what I was just going to say. There's just too many lessons. There's too many things to go through. But we are going to start going into those smart money concepts. If not next lesson, then definitely a big one on it, the lesson after. And I've got our resident expert, Des, helping me with that one as well. All right, I'm going to leave it there. There are a lot more patterns like wedges and pennants and flags and ascending wedges and all of that. There are a lot more of those. There are also a lot of different just candles other than just, we went through the evening, morning star, the doji, the engulfings, and the hammers. They're the main ones that I sort of take note of, but there are a heap of others as well. And you can Google up lots of those, or I'll put those ebooks in the chat group so people can have a squiz as well. But yeah, that's about it. I might leave that lesson and go and check on my roast, and hopefully it's not burnt. I'll talk to you all next time, guys.